They say extraordinary allegations require extraordinary evidence. It is a shame that American short seller Hindenburg and Nathan Anderson don't seem to know this quite well. Under the guise of research, their attempt to make a big splash with the Adani Group ended up backfiring spectacularly. Whatever little credibility they had is gone, and they are now entangled in investigations by various agencies across the globe. They tried to target the investigation agencies next, but that too fell flat. You may be wondering, why are we discussing this now when Supreme Court and SEBI both have given Adani Group a clean chit? So here's why. Basically, renowned valuation expert Aswath Damodaran in an interview with ET-BFSI has thoroughly debunked the allegations made against the Adani Group by Hindenburg. He argues that Hindenburg's questioning of Adani Group's score and values is completely unfounded. Take a look at the key points he made. Number one, Hindenburg had called the whole Adani Group a scam, but Damodaran said that this was just not true. The Adani Group is a competent infrastructure company in a country which is in massive need of infrastructure. He goes on to clearly state that the Adani Group's story is an integral part of India's growth story. Number two, and here he made a very interesting point. He said that given the share price of the Adani Group, they could have easily raised equity, but they choose not to dilute their ownership. This is a common trend among family-owned businesses as they prefer to maintain control over the company for healthy growth and expansion. Number three, he is not at all concerned about the debt on the Adani's balance sheet. This is because infrastructure companies around the globe tend to borrow more than many other companies. The Adani Group has massive infrastructure projects underway, and they have taken on debt to fund these projects. And this is publicly disclosed, and they are committed to completing these projects. Now, how do you evaluate any company's debt situation? How do you exactly know that the company is healthy and is growing? Yes, we all know a company's ability to service debt is measured by debt to EBITDA ratio. The lesser the ratio, the healthier are the books. So, in a May 2024 annual report, the Adani Group reported that they had reduced their debt to EBITDA ratio to 2.5 times within 6 months and further improved it to 2.2 times in Q1 FY25, which is a multi-year low. This is from as high as 7 times about 5 years ago. So what do these figures exactly indicate? They show that when the company needed capital for growth and larger projects, it took on debt. They completed those projects and expanded. As the company gained momentum and grew rapidly, it reduced its debt to improve its financial health and this ratio. Now, number fourth, Damodaran also disagreed with Hindenburg's allegation against SEBI and its chairperson. He said, pushback is a natural reaction whenever regulators introduce new rules. He also explained that in India, bureaucrats don't benefit from making decisions, but they do pay the price if those decisions turn out to be wrong. So all in all, whatever bogus allegations Hindenburg made are repeatedly getting refuted by experts from all walks of financial ecosystem. And what about the Adani Group, you may ask? Well, it continues to play a silent role in India's growth story.